we use this napkin to demonstrate the difference between the two when it comes to actually accessing our money after we've done a good job of growing it, right? So if we come back to that analogy where we've got $1 million sitting in our RSP account, the person in retirement is looking for 60K, they have to withdraw 100, pay nearly that 40% tax in order to get 60, right? We discussed that earlier, right? If we do this for 5 years in a row and we assume a 0% rate of return, okay? This is an oversimplification, right? At the end of 5 years, we're gonna pay $200,000 in taxes. We're gonna live on $300,000 of money. And at the end of the day, with 0% return, I have $500,000 left inside of my RSP account. Right now, let's just say in year 6, markets did really well and we decided we were going to invest, so we get a 10% return. I now make $50,000. My investment is now at $550. And now we're hoping to see that hopefully next year, we don't know what's going to happen market-wise. But what this ends up happening is because we actually have to access the money and because we have to pay taxes, sooner or later, our money is going to shrink and die, right? Next year, we might have $450 and then $350 and $250 if we got 0% return. And so sooner or later, we're going to be out of money. And worst case scenario is, maybe we're not out of money, but something happens here where we pass away, right? Now the government's coming for, 50+% of our asset, and we need to make sure that we're protecting it. But if we take a look at the permanent tax shelter side of things, if I have the $1 million here, the way that we actually use this and access this is actually through a line of credit. Okay, so we're either going to go to the insurance company or we're going to go to a bank and we're going to ask them for a line of credit. What they're going to do is they're going to say, okay, no problem. Here's your $60,000 on a line of credit. They are going to charge us some interest, right? We'll talk about that part later. But I don't have to actually pay any taxes because I'm borrowing the money and I don't have to touch the money, which is fantastic. And so if I do the same 5 years, what ends up happening is I pay 0 in taxes over those 5 years. I get to live on the same $300,000 that I got to live on over here. And now what ends up happening is when I ask the question of how much money is left inside of my permanent tax shelter, most people will say, well, 700,000. You lived on 3, you had $1 million, it's 700, right? And the neat part is we actually still have $1 million left inside of our asset. And I really always relate this to real estate because people understand it. If I had $1 million house, right? If I sold my house, it's worth $1 million, but I owed $300,000 on a mortgage. Would I sell my house for 700? No, right? I'm going to sell my house for $1 million. It just means that when I sell it, the first person that has to get paid back is the bank, and I get to then pocket the 700. And this works the same way where I owe something against the asset. And if I die, then yes, there's $700,000 that have to go to my beneficiaries because I have to pay back this line of credit. But if I don't die, the $1 million is still working for me. So if I get that 10%, I'm actually going to grow $100,000. And in year 6, I now have 1.1 million. And then I'm going to have 1.2 and then 1.3 and 1.4. And this is going to exponentially grow because all of the money is there. I'm not physically taking it out of my pocket to spend it. And so we really need to not just grow money. We need to know that when we reach retirement, how are we going to access our money and where are we going to access it so that we can make sure that not only do we live a tax efficient retirement, but we actually get to pass on our assets to our beneficiaries. And so this is the difference between living on an RSP or living on a permanent tax shelter.